Investing safely in the U.S. market is a journey that requires a deep understanding of available investment options, how the financial markets work, and the strategy that best aligns with your goals and risk profile. Below is a more detailed, comprehensive guide on how to start investing safely in the U.S. financial market. 1. Educate yourself on investment options. Before you start investing, it's crucial to understand the range of investment options available in the U.S. market. Each type of investment comes with different risks and returns, and choosing the right one depends on your financial goals, risk tolerance, and time horizon. Stocks represent ownership in a company. When you buy a stock, you're purchasing a small part of the company, and the stock's price fluctuates based on the company's performance and market conditions. Stocks have historically provided high returns, especially over the long term, but they are also more volatile in the short term. Investing in individual stocks allows you to directly participate in a company's growth, but it can be riskier if the company faces challenges. To mitigate risk, many investors choose to invest in stock indexes or exchange-traded funds, ETFs, instead, which provide exposure to a broad range of companies. Exchange-traded funds, ETFs, are a popular investment option that allow you to diversify by investing in a collection of stocks, bonds, or commodities. ETFs are traded like stocks on exchanges, making them highly liquid, and they are often used to track broad market indexes such as the S&P 500 or the Nasdaq. Because ETFs hold a basket of assets, they offer diversification, which helps reduce risk compared to investing in individual stocks. ETFs are also cost-effective, typically with lower fees than mutual funds, and they offer flexibility since you can buy or sell shares during market hours. Bonds are debt securities issued by governments, municipalities, or corporations. When you invest in bonds, you are lending money to the issuer in exchange for periodic interest payments and the return of the principal amount at maturity. U.S. Treasury bonds are considered one of the safest investments because they are backed by the U.S. government. Bonds tend to be less volatile than stocks and provide stable income, but they also offer lower returns. While they can be an excellent option for conservative investors or those seeking income, bonds are sensitive to interest rate changes and inflation. Real estate investment trusts, REITs, are another investment option that allows you to invest in real estate without the need to own physical property. REITs pool capital from investors to buy, manage, or finance income-producing real estate, such as office buildings, shopping centers, and apartment complexes. They distribute a significant portion of their profits in the form of dividends, making them an attractive choice for income-focused investors. REITs are traded on stock exchanges like ETFs, so they offer liquidity and accessibility, but they are also affected by real estate market conditions and interest rate fluctuations. Commodities and cryptocurrencies are higher-risk investment options that might appeal to more aggressive investors. Commodities like gold, oil, and agricultural products are tangible assets whose prices are influenced by supply and demand dynamics and global economic factors. These investments can serve as a hedge against inflation or economic instability, but are known for their price volatility. Cryptocurrencies, such as Bitcoin and Ethereum, are a relatively new asset class that operates on blockchain technology. While they offer high potential returns, they are extremely volatile and subject to regulatory uncertainty, making them a risky option for less experienced investors. 2. Define your investment goals. Defining your investment goals is a critical step in building a strategy that aligns with your financial objectives. Without a clear goal, your investments may lack direction and focus, potentially leading to poor decision-making. Start by asking yourself what you are investing for. Are you saving for retirement, a down payment on a house, your children's education, or building wealth over time? Each of these goals requires a different approach in terms of asset selection, time horizon, and risk tolerance. The time you have to reach your goal is one of the most important factors to consider. If your goal is short-term, such as saving for a house in the next few years, you'll likely want to prioritize stability and safety, which means choosing lower-risk investments like bonds, high-yield savings accounts, or certificates of deposit, CDs. For longer-term goals, such as retirement, you have more flexibility to invest in higher-risk options like stocks or equity-focused ETFs, as you can weather the volatility of the market over time and take advantage of compounding growth. Your risk tolerance plays a significant role in shaping your investment strategy. If you are risk-averse and uncomfortable with the possibility of losing money, you might focus on safer investments like bonds or treasury securities. These provide more predictable returns, though they come with lower growth potential. On the other hand, if you're willing to take on more risk for higher potential returns, you may allocate more of your portfolio to stocks, ETFs, or even alternative investments like real estate or commodities. Understanding your comfort level with risk ensures that you can stick with your investment plan, even when the market experiences turbulence. Having clear goals and a deep understanding of the time frame and risk involved will help you develop an investment strategy that's right for you. Whether your priority is preserving wealth or growing it aggressively, defining your goals early on makes it easier to choose the right investments and stay disciplined in your approach. 3. Build an emergency fund first. Before diving into investments, it's essential to first establish an emergency fund. This fund acts as a financial safety net, protecting you from the financial strain that can result from unforeseen events, such as job loss, medical emergencies, or urgent repairs. Life is unpredictable, and having readily accessible funds in case of an emergency prevents you from being forced to liquidate investments or take on debt at inopportune times. The general guideline for an emergency fund is to save enough money to cover 3 to 6 months' worth of living expenses. This ensures that, in the event of a job loss or other significant financial setback, you have enough resources to manage your day-to-day needs without panic. The emergency fund should be kept in a highly liquid, low-risk account where you can easily access the money without penalties. Good options for this type of fund include a regular savings account, a money market account, or a high-yield savings account. Money market accounts, in particular, offer slightly higher interest rates compared to regular savings accounts, while still maintaining a high degree of safety and liquidity. Building an emergency fund can take time, but it's crucial to prioritize this step before moving into more complex or riskier investment strategies. Without this cushion, even small financial setbacks can lead to larger problems. Once the emergency fund is in place, you will be in a stronger financial position to take on investment opportunities without the constant worry of an unexpected financial emergency. 4. Know your investor profile. Knowing your investor profile is one of the most important steps in creating a safe and effective investment strategy. Your investor profile reflects your risk tolerance, which is the amount of risk you're comfortable taking on in pursuit of potential returns. Understanding your risk tolerance ensures that your investments align with your financial goals and help you avoid taking on more risk than you can handle. There are 3 primary investor profiles: conservative, moderate, and aggressive, each with different preferences and strategies for balancing risk and reward. A conservative investor values safety and capital preservation above all. This type of investor is willing to accept lower returns in exchange for minimizing the risk of losing money. Conservative investors tend to favor investments that offer stability and reliability, such as U.S. Treasury Bonds, certificates of deposit, CDs, and other fixed income securities. These investments are less volatile and provide steady, predictable returns, making them ideal for those who prioritize safety over growth. While the returns from these investments are generally lower, the peace of mind they provide is invaluable for those with a low tolerance for risk. Moderate investors strike a balance between risk and reward. These investors are willing to take on some risk in exchange for the potential of higher returns, but they still prioritize preserving their capital. A moderate investor might choose a diversified mix of assets, combining both stocks and bonds in their portfolio. This approach helps to manage risk while still offering growth potential. Exchange-traded funds, ETFs, and mutual funds are excellent options for moderate investors, as they provide diversification and are generally less volatile than individual stocks. This balanced approach offers the potential for growth while reducing the likelihood of significant losses. Aggressive investors, on the other hand, are willing to take on higher levels of risk in order to maximize their long-term returns. These investors typically have a higher tolerance for market volatility and are prepared to weather the ups and downs of the market. They often invest in individual stocks, startups, venture capital funds, commodities, or even cryptocurrencies, which have the potential for high returns but also come with the risk of significant losses. Aggressive investing requires a long-term perspective and the ability to withstand market downturns without panicking. Investors who adopt this profile usually have the financial flexibility to take on more risk and can afford to wait for their investments to grow over time, often focusing on capital appreciation rather than immediate income. By understanding your investor profile, you can make investment choices that suit your risk tolerance and align with your overall financial goals. Whether you're a conservative, moderate, or aggressive investor, knowing your profile allows you to build a portfolio that fits your needs and helps you stay focused on achieving your financial objectives. 5. Start with low-risk investments. When beginning your investment journey, it's important to start with low-risk options to minimize the possibility of significant losses. This approach helps build your confidence and understanding of the market while protecting your capital. Several low-risk investment options can offer safety and steady returns. One of the safest investment choices is U.S. Treasury Bonds. These are debt securities issued by the federal government, known for their stability and reliability. Treasury bonds typically have maturities ranging from 10 to 30 years, and they offer a fixed interest rate, making them appealing to conservative investors seeking a predictable income stream. Due to their government backing, Treasury bonds are considered one of the safest investments, as the likelihood of default is extremely low. For those concerned about inflation eroding their purchasing power over time, Treasury inflation-protected securities, TIPS, are another option. These bonds are specifically designed to protect against inflation because their principal value adjusts with inflation rates. TIPS are ideal for investors looking for stability in real value, especially when inflation is a concern. They provide a fixed interest rate, but the principal increases with inflation, ensuring that the purchasing power of the bond is maintained. Another low-risk investment is certificates of deposit, CDs, which are time deposits offered by banks. When you invest in a CD, you lock in your money for a fixed term, typically ranging from a few months to several years, in exchange for a fixed interest rate. The longer the term, the higher the interest rate offered, making them an attractive option for conservative investors seeking guaranteed returns. While CDs are very safe and offer fixed, predictable returns, they do come with a trade-off in terms of liquidity. If you need to access your funds before the term expires, you'll typically face penalties, which means they aren't ideal for emergency funds but work well for longer-term savings goals. For those looking to invest in a low-risk, diversified portfolio, fixed income funds offer another excellent option. These funds primarily invest in debt instruments like government bonds, municipal bonds, and corporate debt. They can provide steady income while mitigating risk through diversification. Fixed income funds are typically managed by reputable investment firms like Vanguard and Fidelity, which offer low-cost options. The level of risk associated with fixed income funds depends on the types of bonds or debt securities the fund holds. Government bonds are lower risk, while corporate bonds can carry slightly higher risk, but they also offer the potential for higher returns. By investing in a fixed income fund, you gain exposure to a range of bonds, which helps reduce individual risk. 6. Diversify, the best way to protect against risk. Diversification is one of the most effective ways to protect your investment portfolio against risk. The principle behind diversification is simple. By spreading your investments across different asset types, industries, and geographic areas, you can reduce the impact of a downturn in any one particular area. A well-diversified portfolio has a better chance of weathering market volatility and minimizing losses during times of economic uncertainty. Exchange-traded funds, ETFs, are an excellent tool for diversification. ETFs are investment funds that hold a basket of assets, such as stocks, bonds, or commodities, and they are traded on exchanges like individual stocks. One of the biggest advantages of ETFs is their ability to track broad market indices, such as the S&P 500 or the NASDAQ 100, providing exposure to a wide variety of companies across multiple sectors. For example, the S&P 500 ETF gives you exposure to 500 of the largest companies in the US, reducing the risk associated with investing in individual stocks. ETFs are also cost-efficient because they typically have lower management fees than mutual funds, making them an attractive option for cost-conscious investors. Mutual funds, similar to ETFs, provide diversification by pooling money from multiple investors to invest in a variety of assets, such as stocks and bonds. The key difference is that mutual funds are usually actively managed by portfolio managers who aim to beat the market by selecting the best-performing securities. While actively managed mutual funds can offer the potential for higher returns, they often come with higher fees. On the other hand, index funds, which are a type of mutual fund, track specific market indices and have lower fees. Popular index funds from companies like Vanguard or BlackRock allow investors to invest in the broader market or specific sectors with low costs and automatic diversification. For investors who want to target specific sectors or industries, sector-specific ETFs are a good option. These ETFs track particular industries, such as technology, healthcare, or renewable energy, allowing you to focus on sectors you believe have strong growth potential. By investing in sector-specific ETFs, you can gain targeted exposure to industries that may outperform the broader market over time, while still maintaining the diversification benefits that come with ETFs. However, sector-specific investments tend to be more volatile than broad market ETFs, so it's important to assess your risk tolerance before diving into these types of investments. Incorporating diversification into your investment strategy helps balance risk and reward by spreading your exposure across different asset classes and sectors. Whether through ETFs, mutual funds, or sector-specific investments, diversification remains one of the best ways to safeguard your portfolio while still aiming for growth. 7. Regular monitoring and adjustments. Investing is not a set-it-and-forget-it activity, and one of the key aspects of successful investing is regular monitoring and adjustments to your portfolio. The financial markets are dynamic and constantly changing due to factors such as economic shifts, interest rate adjustments, corporate performance, and geopolitical events. These changes can affect the performance of your investments, making it necessary to periodically review your portfolio to ensure it continues to meet your financial goals and risk tolerance. Most investors aim to review their portfolio at least annually, but it's important to stay alert for significant changes in your personal circumstances or the broader market. Life events such as a career change, marriage, the birth of a child, or approaching retirement may alter your financial situation or investment objectives. If your circumstances change, it may be necessary to reassess your goals and adjust your portfolio accordingly. For example, if you're nearing retirement, you may want to shift towards more conservative investments to reduce risk and preserve your wealth. On the other hand, if you experience a windfall, such as an inheritance, you may choose to reassess your asset allocation to ensure your portfolio remains diversified and aligned with your long-term goals. In addition to life changes, market conditions can also impact your portfolio's performance. For instance, during a market downturn, certain investments may lose value, and you may need to rebalance your portfolio to maintain your desired asset allocation. This could involve selling some investments that have overperformed and reallocating the funds into areas that have underperformed, helping to maintain diversification and reduce risk. Conversely, if a certain asset class has outperformed, it might make up a larger portion of your portfolio than originally intended, increasing your overall risk. Regularly rebalancing ensures that your portfolio stays in line with your initial risk tolerance and financial objectives. Rebalancing your portfolio is an important task that should be done periodically or in response to major market movements or changes in your financial life. By consistently reviewing and adjusting your portfolio, you can maintain a balanced approach to investing and stay on track to achieve your financial goals. 8. Take advantage of tax-advantaged accounts. In the U.S., one of the major benefits of investing is the ability to take advantage of tax-advantaged accounts. These accounts allow you to either defer taxes on your investment earnings or avoid paying taxes on them altogether, depending on the type of account you choose. Utilizing tax-advantaged accounts can significantly enhance your long-term returns, as they help you keep more of your investment gains. One of the most popular tax-advantaged accounts is the Individual Retirement Account, IRA. The IRA offers two main types: the traditional IRA and the Roth IRA. A traditional IRA allows you to contribute pre-tax income, meaning that your contributions reduce your taxable income in the year you make the contribution. The earnings in the account grow tax-deferred, meaning you won't pay taxes on them until you withdraw the funds, typically in retirement. While this provides immediate tax relief, you will be taxed on the withdrawals in retirement at your ordinary income tax rate. In contrast, a Roth IRA offers tax-free growth and withdrawals, provided you meet certain conditions. Contributions to a Roth IRA are made with after-tax dollars, meaning you don't get an immediate tax break, but the earnings grow tax-free, and qualified withdrawals in retirement are not taxed. Roth IRAs are particularly beneficial if you expect to be in a higher tax bracket during retirement or if you want to minimize your tax burden in retirement. Both types of IRAs have contribution limits, and each has its eligibility requirements, so it's important to understand the rules before contributing. Another significant tax-advantaged account is the 401k, which is an employer-sponsored retirement plan. If your employer offers a 401k plan, it's highly recommended that you take full advantage of it. One of the most compelling features of a 401k is the potential for employer matching contributions. Many employers will match a portion of your contributions, which is essentially free money that can help boost your retirement savings. Contributions to a 401k are made with pre-tax income, reducing your taxable income for the year, and the funds grow tax-deferred. Like a traditional IRA, taxes are paid when you withdraw the money, typically in retirement. 401k plans often provide a variety of investment options, including mutual funds, ETFs, and company stock, so you can tailor your investment strategy within the plan. In addition to the tax benefits, many employers offer automatic payroll deductions, making it easier to save consistently. Some 401k plans also offer Roth options, where contributions are made with after-tax dollars and qualified withdrawals are tax-free, similar to a Roth IRA. Taking advantage of these tax-advantaged accounts is one of the most efficient ways to build wealth over time, as it allows your money to grow faster by reducing the amount you pay in taxes. Whether you choose a traditional IRA, a Roth IRA, or a 401k, these accounts provide substantial tax benefits that can accelerate your progress toward meeting your financial goals.